You want to know, what are the best stocks to buy now? You work hard for your money. The last thing you want to do is lose it in the stock market. I'm going to help you be careful and avoid the pitfalls of Meme Mania 3.0. I got 5 stocks that I bought today. I'm going to share with you. Let's go. You're here because you want to build wealth, and we're doing that together. You're investing in stocks to improve your financial future. Now, part of that process isn't just buying stocks, it's also knowing when to take some chips off the table. I'll talk about it later in the video, but let's get right into the stock picks. This first stock is sitting between 3 very hot topics right now, with data security and AI right in the middle, and it's Rubrik. And if you believe cybersecurity is one of those secular growth trends in your portfolio, this could be a good play in addition to other names like CrowdStrike, Zscaler, and more. It's going to take your on-prem, your cloud, your SaaS, your unstructured data, your identity, and it's going to give you everything you see right here. Rubrik is going to help enterprise businesses connect data and identity. This is a software as a service or a SaaS company. Cyber resilience is the future of cybersecurity. You're going to notice 3 fired up wall favorites here: Palo Alto, Zscaler, and CrowdStrike. So we already own these. We have good cost basis in these stocks. Now we've been building up a position. I even bought more shares this morning of Rubrik for data and identity resilience. And this stock was definitely in high demand this morning. You're talking about a low of $76.56. I bought some around 77, and all of a sudden I looked and it was up 9% or something since I bought it. So this ripped from a low of $76.56 to a high of $83.97, trading right now at $82 a share, up 3%. And this is posted in Discord under Eric's watch list. But Rubrik right here, that EVNTM revenue, right? We're going to use this for cloud SaaS. It's a 13x. I think that's attractive for what you're getting in the growth. That free cash flow margin 7%, but this is a young and growing business. The NTM rule of 40 score is a 51%, which is very solid. Of course, you want to be above 40, and that net dollar retention is 120%. So they're keeping customers happy, and they're continuing to add on new modules, and customers are spending more money with Rubrik is what that means. April, you had a great deal under $50. If you missed that, well, it ripped up to 100. Now it's pulled back again. We were buying this around $75 a share. It did get to this S3 Fibonacci, $72.95. So really anything in that range, 75 or less DCA is what we were targeting. It is 82, so I think you can still probably buy some shares here. I think there's upside to it, especially if you're a long-term investor thinking 3, 4, and 5 years. Understand this. If you look at a chart and you see that it dropped from $80 to $47, if we have a sell-off again, it could easily go back to these levels. So if it's at $82 a share, if it sold off and went to here, you can't be shocked by that because you know it can happen. It just happened in April. I'm not saying it's going to happen, but understand these higher beta names, they can have downside action if you have any kind of sell-off or bear market activity. So this is going to have high risk reward, and that might not be the best fit for every risk tolerance for everybody watching this video. If that's the case, hold on, because I got a couple dividend stocks I'll talk about later in the video that might suit you better. This next stock is under pressure for a few reasons. I think the biggest one has to do with weight loss drugs and how that impacts different companies. For example, Pepsi. People aren't eating as many snacks, so they're healthier. They don't need as many prescription drugs. They don't need to have as many surgeries. And so there is some unknown there, and I will say that healthcare can be difficult. Earlier this year, I made a top 10 high conviction stocks for the next decade. And when I talked about healthcare, I said it was very difficult, and one of the runner-ups was Intuitive Surgical. Now, if you follow me, you know that I like investing in companies that have recurring revenue models versus, like, for example, an application where advertising dollars, they have to fight for it every single day, every single week. This recurring revenue helps create a steady revenue stream, a general stream upwards, and that churn rate, that volatility, the ups and downs, the peaks and valleys just aren't quite as high. I'm just doing a quick search here. Intuitive Surgical, about 84% of its total revenue in 2024 is recurring revenue, which I think is important for investors to understand. We're talking about almost 7 million procedures in 2024, almost 1,800 new systems placed last year, and over 11,000 of these systems in hospitals globally. Now, this is going to be robotic surgery. And of course, technology is under a disruptive phase right now, and that could look different if you zoom the lens out a few years. But overall, I think this is a solid company. They have a first mover advantage. If you talk to anybody in healthcare, they're going to tell you that this is a good stock to buy at these levels. Worldwide procedure trend is still up 17% growth. It's much more of a mature company than it was was years ago. You talk about that cycle, right? From hyper growth, mature growth, and so on. But this overall install base is going higher, albeit maybe at a slower clip than it once was. I think that recurring revenue does create some barriers to entry. I don't think it's as simple as somebody coming along and just ripping and replacing these systems. It is highly profitable, 66% gross profit margin. Got an A+ here on Seeking Alpha, bringing in about $167,000 net income per employee TTM. The growth on it, like I said, it's not hyper growth, but it's solid. Forward revenue growth projection about 16%. So you're getting 16 to 20% growth. Now, valuation wise, you can look at something like a GAAP forward P ratio, and it's going to look expensive at 62. But remember, 80% plus revenue is recurring. So this is very different than a company that has no recurring revenue at all. Short interest of 1.52% tells you that not a lot of people are really betting against it at this point, and it is down about 10% in the past year and down about 16% year to date. So when most stocks are flying off the shelf, this is one that's down. Oftentimes buying against the grain is where you can make money. We're talking about $159 billion market cap, so it's not small by any means. And looking at a chart, you can see here is running hot, really a double top area, about 610 bucks. It fell off a cliff here and it got down to this S3, $432.70. And you are finding some buyers here. If it comes lower, this trend line's around $400. And I think that's a psychological level. I'm not saying it can't break $400, but I do like this. If you look at the April lows here, this got down to $425. I think that's probably a decent floor unless you have some additional information or catalyst, like an earnings miss or a short report that comes out and says there's a bunch of competition, something like that. Without that, I think the algorithms, right, electronic tradings and the quants, I think you're probably going to hold this $425 level. So if you're buying at $435, $440 using dollar cost averaging, I like this stock a lot, especially considering it came from $600, and I believe it is a high quality name. One of the better names in healthcare, even though it's a tough sector. Robotic surgery, secular growth trend in my opinion, and I think this is a good stock to buy right here, right now. I'll be completely honest with you guys. This is a complicated company, and that's part of the reason why the stock is down. Nobody understands it, even the analysts that cover it. The recent mergers and acquisitions with Clearwater Analytics, the ticker is CWAN, have made this a very complex beast. And part of the problem is this is a SaaS company, but remember it's dealing with institutional banks and clients that just move very slow. So these sales cycles, I worked in software as a service. I know how software cycles work. They can be slow to begin with when you have lots of money in an enterprise deal, but these type of businesses are slower to move than many other businesses. The other day in Chart Day, I referenced it as the old boys club. When you include Infusion with this platform, it completely changes the company. One of the quotes here, every new asset or jurisdiction we enter brings more manual workarounds. We're juggling over a dozen systems and none are built for today's regulatory complexity. We're not just inefficient, we're exposed. And what Clearwater can do is help with all of that. It allows these systems to integrate. So there's a strong use case here from a sales side. And then when you combine Beacon and Bistro on top of Infusion, the whole platform, it's a beast. In Fired Up Wealth, you know that we love flywheels. And here's what the entire company looks like when you put it all together. So research, reporting, reconciliation, risk and performance, pre-trade compliance, everything is included here. The problem is nobody understands what this does and no one understands the industry to begin with. Another quote here, I'm intrigued to see what you guys can do in building a game-changing platform. It is the holy grail, but I just haven't seen anyone bring this home yet. There's a lot going on right now with globalization of assets, and Clearwater is positioned very well to help these institutions accomplish a lot of different goals. And this is helpful, I think, for investors in case you don't know the different markets. So insurance is a huge total addressable market here. Hedge funds, asset managers, asset owners. This is the clientele that CWAN is targeting. So they acquired a product called Bistro from Blackstone, and then you have Infusion, Beacon, and Clearwater Analytics, which was the company before these acquisitions. The big question here is how can they put all this together? How can they make the M&A work? How can they make the culture of all these different companies come together and make this uniform platform that can go out and win business across multiple sectors? Now, this is a $5.2 billion market cap, so it's a smaller market cap. It has some risks. I think this sentiment right here it clears it up for you. Clearwater Analytics, near-term uncertainties make me cautious, and there just are a lot of unknowns. So you're taking a chance here. When you have uncertainty, it's going to make the sentiment sentiment bad. Nobody wants to buy the stock. It's down 30% in the past year. Year to date, down 35%. So this is a very unique company. It was founded in 2004. Of course, it looks very different now with those acquisitions. It's headquartered in Boise, Idaho. It is software as a service, SaaS, recurring revenue. When you look at the SaaS metrics, it's not very expensive. The problem is it doesn't matter if nobody knows about the company, if nobody understands the company, if nobody wants to buy the stock. This is one of those stocks that you could buy here at 18 bucks. I think it's worth $25 and you can make some money on it, but there's a chance it could drift lower because the sentiment's just really bad. And if nobody understands the stock and there's no interest in it, it's a smaller cap, it's under the radar, it's probably not going to do anything anytime soon. But if you look at how we buy, we often buy against the grain when nobody else is talking about a stock, when nobody understands a stock. And then all of a sudden you see the value unlocked and the revenue starts to increase dramatically and people say, wait a minute, this is actually really cheap here. It should be worth $25, $30 and boom, you make an 80% gain. So this is going to be a long-term investment. And you can see it was $35. This is way ahead of itself. I do believe this stock should be $25 a share. You can see back here in 2024, it dropped down to 16. If you add the combined value of these companies, I believe it's definitely worth more than $20 a share. Now this S3 is just under $17. This is $16.86. Now currently we're just below this S2 and you can see support here, kind of a double bottom area, $17.63 here and then $17.98 here. So it could hold up somewhere where it's at now, but there's a chance it could go lower. When you look at a chart that's this bearish and the sentiment's bad, I would expect it to go lower, probably going to go to the S3, maybe even lower, but it could hold up this red line here somewhere between $17.50 and $18. If you look closely, you are seeing some more buyers come in, but the volume's just not quite there yet. This is one that will take patience. So if that's not you and you're looking for a quicker win, this is not the stock that you want to buy. Now, if you look at the win streak that we have right now in the NASDAQ, it's one of the biggest in history. And that's regarding the number of days above the 50-day moving average. So, of course, we were running hot, dropped hard here in April down to 16,542, ripped all the way up above the R3, some consolidation, but we're still above this 50-day simple moving average. And if you look at historic valuations, things are stretched, especially in certain areas of the market. You also have massive concentration, a handful of stocks that are highest weight within the indexes and also bringing the most earnings per share. Without the AI trade, the market would look very different. Does that mean we're toast? Absolutely not. But it does mean, in case you're not in the private community, you should have some cash. I'm not saying you should liquidate and sell your portfolio, but have some cash. Maybe 5% if you're younger. If you're older, if your time horizon is not as long, maybe you want as much as 10 or even more percent. Now I've got two more stocks for you. If videos like this are helpful, please make sure you hit that subscribe button so you don't miss the next one. We do videos like this pretty much every week. Now you might be surprised to see that Accenture is down about 31% in the last year, down 34% year to date. This is a larger company, $148 billion, $149 billion market cap. It's got about 2% short interest, so not a ton of people betting against it here. And of course, part of the problem with this stock is it got ahead of itself with the AI trade. And if you look at this, just had earnings here, we're talking about 2 to 5% revenue growth. Now, this is not a hyper growth stock, not at all. This is going to fit in that dividend category, more in the DGI, dividend growth investing. You got around a 2.5% dividend yield, payout ratio is 47%, 13% 5-year growth, and dividend growth of 14 years. So this, my friends, is a good fit, and I just bought it today, a new position in the dividend portfolio. Now, if you're a young investor in the accumulation phase, this might not be your huckleberry. But if you're looking for a profitable company, got an A+ profitability grade here on Seeking Alpha, doesn't have a ton of growth, but it is growing, has some upside, of course, with the AI trade. And this is consulting services, so it's important to note that it does have a lower margin profile because of the nature of the business. And the valuation, that PE gap forward, is about 18.5. But again, that growth is 2 to 5%, so it doesn't support a higher premium. So in Discord, under Eric's dividend portfolio, you can see 5 shares. It's a new position, starter position. I bought some shares at $234.77, but I want you to hear this. My preference is 225 or less DCA, and I'm going to show you a chart here in a second. Now, keep in mind, if you're going to buy ACN in a taxable brokerage, you might want to pause the screen and read this because it could impact your taxes. Looking at the chart, the S3 Fibonacci, 225.48. Again, my preference is 225 or less DCA. I did nibble a small position. I'm expecting it to go lower. This stock was up to $400 a share, and it was way ahead of itself. A lot of people put some hype behind it because of the AI trade. And And check this bad boy out, 5.16% dividend. This payout ratio is a little higher than I like, but I do classify this as an income stock. With that said, it has 11% 5-year growth and 56 years of dividend growth. So you can classify this really as DGI or income. The problem right now is it's not growing. So of course it's not gonna have a premium, and that valuation is under 11 for the gap forward P ratio. Now this is one of those, it could be a value play or a value trap, and it also might not be a good fit for a lot of portfolios. Again, if you're a younger investor, if you've got a longer time horizon, if you're in the accumulation phase, this probably is not a good fit. This is an income stock more for that end game passive income. I actually like this stock, really $100 or less DCA. This S3, you can see it's getting close, $85.65. Could it go lower? Sure. Could it go to 75? Sure. The fundamentals are going to be important. You got a new CEO. The question is, can they turn the story around? I believe that Target can, and I think these prices are attractive for the right portfolio. Thanks for watching, guys. Don't forget to subscribe, like, and comment. Have a great rest of your day. Take care.